Hello, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, master trader Ira Harris. Hello, Mr. Harris. Thanks for joining us today on USAWatchdog.com.
Great. It's a great pleasure to be here with you. We've really done some nice things, and hopefully we'll get something accomplished today.
Well, I think we will. You know, you are a master trader. When you're a master trader, you are really good at analysis. And that's the reason why we're calling, not for your trading tips, but for your analysis, which you've been spot on, made big calls because of your analysis, and that produces a trade. And you wrote a thing on your blog, Notes from the Underground, which 2 + 2 = 5, your byline, which I think's pretty funny. You're being facetious, I know. 2 + 2 doesn't equal 5, 4, of course, but, where, sometimes people don't think logically, and the markets don't react logically. But the Fed came out recently and said they got really coy with their language. Well, we're either going to increase or reduce QE, which, tapering. And you wrote a piece about tapering QE, and you brought up a great point about them trying to taper the two. It's not really the point. What's your point about your article about the Fed's pickle that they are in?
Yeah, it's not tapering, although the tapering because the market is addicted to this continual ad. But if you're getting any type of traction in the growth of the economy, and as David Tepper today rightly said on CNBC, the tapering really doesn't matter so much because as you get growth, the annual deficit is shrinking anyway. So there's only so much amount of paper that the Treasury is going to relinquish. And if the Fed is buying more than that, what they're doing then, of course, is monetizing the debt. And if you're getting that type of traction where you're getting that kind of growth or enough to at least curtail the deficit and shrink it somewhat on an annual basis, the issue then becomes you got to curtail your buying. You have to, because first of all, there's natural buyers in the market that you cannot chase out. There's pension funds. There's insurance companies. There's all types of people who need to purchase this debt because they have commitments that they have to that they're committed to, annuities and other such things. So you're going to have to. So that all this language about tapering, I'm not comfortable with it anyway. My issue, of course, is not that you're going to cease buying more paper. What do you do with the $3 trillion? I'll say that again: $3 trillion of liquidity you've created over the last 3.5 years. You're going to have to rein that in.
So let me interrupt here. So at some point, doesn't the Fed have to sell this $3 trillion that they've got on their balance sheet?
But you know what? We've always assumed that would be the case, Greg. But the Fed has been making noises that they're not going to do it that way, that they're going to actually just let it, what they call, naturally roll off. So as all of this paper that they bought, as it comes due and has to be redeemed, they'll redeem it back to the issuer and they'll take their cash back, because basically what they've done is a long-term swap otherwise. Now, this started to be in the conversation going back to a speech from the Bank of England, Adair Turner, back in, I think it was back in August of 2012, and my eyes rolled when I first saw it. But there's more and more talk about this. So that raises other issues, because you're going to allow $3 trillion of cash that they created to sit out there in the economy. As the economy starting to take off, that would be, as we would look at, as we've talked about, phenomenally inflationary. But I think that the Fed is looking at a different way if they go that route, because they don't want to crush the market and let the bond vigilantes go to work here, that they have another alternative here or some other alternatives. So I think that's what the conversation I tried to get across in the blog last night.
So you think they're just going to hold to maturity, and you're not going to see this big sell-off of treasuries?
Well, they're floating trial balloons of this conversation. So then my mind goes, well, if they're going to do that, and they know that the impact, of course, would be inflationary, how would they slow down that inflationary impact? And that I think they're going to do, Greg. This is what the noise is that they're making through what we would call macroprudential regulation, which is that they would put great restrictions on the banks, which, don't forget, the Fed regulates the banking market. They didn't do a very good job of it prior to 2006 or prior to 2001, but they do it. And if they put very severe capital regulations on, they could slow that velocity. So it just makes you think about, well, maybe we need to start thinking like they're trying to think outside the box. So I, as a trader, want to start thinking outside the box too and understand where they could possibly go here.
Do you think the market is pretty weak? I mean, listen, they're printing $85 billion a month to suppress interest rates, mortgage interest rates, and Treasury interest rates. I mean, it's 40 for the mortgage-backed securities, that's what we know of, and 45 for buying Treasuries. I mean, aren't they doing this to prop up the market? If they stopped that tomorrow, I mean, you'd have a kaboom in the market, wouldn't you? It would sell off hard.
We would think that, okay, but let's look at it the other way. Tapering by itself does not raise interest rates, right? We know that. Now it may raise rates on the long end. There'll be a backup as the market, but I would argue that over any medium-term period or short-term period, again, it's not that the long rates are going to make this market. Yes, you'll get a correction. There's no question about it. How big, I don't know. But you'll see a steepening out of the curve because we know they will not move to raise rates on the short end. So yes, the market forces will push the long end rates higher. They can't affect the short end rates. I mean, you'll see a steepening. And I think that steepening will actually be a positive. So if you were to get a correction, and if you got a 10, 12, 13% correction, it would be an opportunity for investors to buy until the Fed started moving on the short end. But we're not looking for them to do that. And tapering by its own, by removing the bond purchases, that's not going to lift rates on the short end.
What happens if they...
Not in a meaningful way.
I mean, aren't we entering a stage where everybody's kind of printing, as Jim Rogers told me from Singapore, if they keep printing money, it'll be a disaster. If they stop printing money, it's going to be a disaster. Either way, it's going to be a disaster. I mean, this is going to be a disaster, isn't it? When does the money printing stop?
Well, that's why we're going global with this, because if the Fed, quote unquote, tapers back, and again, I hate that phrase, because that's not really doing anything except cutting the amount you're immediately spending on a month-to-month basis and doing the roll-off. But if they get the European Bank to really pump, they haven't. They did initially, but the original QE, which was a LTRO, which is a long-term refi, has been curtailed back. They've paid that back already, some of it.
But I understand this whole European Bank, and the reason why they're doing it is because they don't want anybody to take losses. When does somebody have to take a loss? When do we have a situation where, wow, you made a mistake. This is capitalism. Well, if you believe in capitalism, you believe in bankruptcy. You need to go to receivership. When do we get a loss? Why do we put this on the population of the globe? Because, whoa, we can't have any bank take a loss.
Well, you know what, and that's a good point. So what did we hear come out of the G7? And Draghi tried to push through ABS buying by the ECB, okay, asset-backed securities, in which each individual nation state would bundle the bad loans that are sitting on their banks, push them into these asset-backed securities, which is another derivative that they'll be creating, and push them to the ECB, where the ECB then would put cash in the system. So the ECB would become, under that, as the way I understand it, would become Europe's bad bank.
So they push it onto the taxpayers.
Well, ultimately, or in this case, who's the transfer agent for Europe? Who's the paymaster?
What's the IMF?
No, the Germans.
Oh, the Germans.
And the Germans are going. Wait, whoa, slow this train down, and they're not hurting enough. In fact, the polls came out today that German citizens view themselves as being pretty good off here, and they're looking askance at the rest of Europe. So you're going to force the ECB, which is really backstopped by Germany, but they're not. But I think you would see the Fed if they had the ECB go full throttle, the Fed could then pull back, or taper in today's. They could pull back because at least somebody else would be picking up the ball. The Fed is worried that there's going to be nobody else to pick up. The Japanese have now come in and they're doing it.
And the theme is to put it off on taxpayers by debasement of currency. I mean, that's what the theme is. The banks aren't going to take a loss. That's what you're telling me.
You can talk about Reinhard Rogoff, but go read Carmen Reinhardt's work on financial repression, which she published in March of 2012. She's done a lot of work. It's unbelievable. And she states openly what it is. Go look at it. It is real. You can repress savers by creating inflation and holding artificial rates low, right? Just like we've talked about. real rates within 5 years of the curve in the United States are certainly negative yield. So you're being financially repressed right now because those rates are being held artificially low by the action of the Federal Reserve. It's not the first time. They did this after World War II. The models vary, near. If you go back to Europe in the 1500s, they used to do it by clipping the coins.
In a nutshell, then, how does this, what's the end game? Where's your analysis say, hey, where's the end game with this problem is going to be behind us? Because it's obviously not behind us. We have huge deficits approaching 17 trillion here in the U.S., and that's without GAAP accounting. You have huge deficits. You have unemployment at depression levels in Spain, 50-some-odd%, Italy, nearly 40%, Greece with youth unemployment, I should say, 25, 30%. I mean, you have huge unemployment, particularly with youth in Europe. You don't have any growth. You basically have a depression in Europe. What's the end game here with the whole global liquidity and with everybody trying to print their way into prosperity? What is your analysis of what's coming? How does this end?
Well, my analysis is doesn't end pretty. Because what do they have to keep doing? The answer is, with printing all this liquidity, they have to recreate the bubble that got you here in the first place because, again, they're hoping to buy enough time. Don't forget.
Buy enough, wait, but how does it, when it doesn't end pretty, what do you say about the end? What's not pretty? What can you describe the end?
Well, at some point, the market is going to exact its price, okay? You can repress me for X amount of time, but I'm going to want to get a real yield for my money at some point. And if I'm not going to get it here, I'm going to go other places. So, of course, the response will be when it really push comes to shove, it will start to see capital controls. We will see it. Because if people don't want you and you got to try to hold on to what you have, governments will do that. We know that.
And interest rates will go up somewhere.
Somewhere, somehow, absolutely. Or, listen, people just won't lend to you. So what are you going to do then? You're going to pay. So
we have another bubble and another explosion of another bubble coming.
As Kevin Warsh, and I wasn't a great fan of Kevin Warsh when he was actually a Fed governor, but he's really been, if you listen when he speaks now at different places, and he said it, a central banker's job is to buy time. Now, what is he buying time for? In the hope that you'll get better policy. Well, you know what? Maybe he's right. And I'm saying he's right in that regard because good central bankers buy time for the policymakers. If policy doesn't follow time, though, that's when we get in trouble. And so far, we haven't seen very good policies. Right now, the Fed has, they've stabilized the situation. They've stabilized the situation. The world was on the verge of going into a depression, I believe. And I think that because you would have been in a downward spiral, capitalism does that, where there's a fire sale of assets and there's huge losses. And with that comes massive unemployment, right?
But at some point, don't you have to take your lumps? Aren't they making this worse? Well, they've blown up their balance sheet. They've done all these bond buying. Everybody is in nirvana at the market, okay? And they think, wow, this is going to, you listen to people like David Stockman, he says it's going to end. And when it ends, it's going to, like you said, it's going to end ugly. I mean, interest rates are going to shoot up. They're going to be bankruptcies. Aren't we really just putting off the inevitable that some banks shouldn't be in business? Aren't we just putting that off and destroying the taxpayer and the yield curve in the process?
Yes, of course we've done that, but by buying time. But at least we didn't go to 25% unemployment. And now that's a big thing. So what do you do in the interim? Yes, but if I take a little bit of the hit every year for the next 10 years, that may not be, from a social policy point, the worst event. If I'm a policy planner, I have to think what is my worst and what is my best outcomes. So if I've prevented the worst outcomes, okay, now it's incumbent upon me to do something with the time that I've been allotted. And if I'm not, and I don't believe that we have. Right now, everybody's, to me, the stock market is an indicator of nothing except people's saying, what's my alternative? Which is what Bernanke's initial plan was. There's a name for this, and that's called the portfolio balance channel, which was trying to get people to take on more risk, right? Because if I take on more risk, I can relieve those who have problem assets. I can relieve them of the risk that's and maybe free them up That's what we're doing. But what are we doing in the interim? Nothing. Has Congress really got their act together? And that's not a pox. That's a pox on everybody's house, as far as I'm concerned. They've done nothing in the interim, and of course they'll sit back and go, "Well, the stock market's going up. I evidently don't have a problem." But that's a false positive if I've ever seen one.
There's plenty of people out there that say that they're making it worse. I mean, really, they're really making it worse because they bought time, they didn't do anything with it. Bankers keep getting bonuses. There's no debt clear out. Even the Bible talks about debt jubilee, about clearing out debt. We've increased the derivatives. We've increased the debt. We're having bank bailouts, bail-ins in Cyprus, and that's the word is going to sweep across Europe, right? I mean, people like Mark Faber and Jim Rogers are worried about their assets being stolen. This doesn't sound like it's better at all. That they didn't buy time, they just made it worse. What say you?
Well, again, but I have to, as you know, remove Europe. Europe is a whole different story. They're trying to paper over Europe.
I mean, so this whole thing, to me and a lot of people, it just smacks of they made it worse. I mean, you don't start bail-ins if you're on the end of a problem. I mean, couldn't Europe suck the entire globe under, including the United States?
Yes, and I think that's what probably keeps Ben Bernanke up more at night right now at this point in time than anything, because Europe is a problem. Europe is an economic problem. It's a political problem. It's a classic study of political economy. And those banks, don't forget, European banks are far more significant role in their capital markets. In fact, they don't have they don't have corporate bond markets like we do. They're small and relative. So banks play a much greater role, which is why they're really going and bending over backwards to protect those banks. Again, with
from
the
insolvency. You were talking about protecting those banks from going out of business. That's what they're doing. Is that right?
Absolutely. Those banks. Look, you can't have 27% unemployment in Spain and not have high non-performing loans. Well, non-performing loans are a banker's problem because you're not talking about a well-developed corporate bond market. Banks are the backbone of the European financial system. End of story.
What do you say to people who say, Europe's not a problem, they fixed that?
You were probably in Jonestown because you're drinking punch and Kool-Aid. You don't understand, and I'm going to advertise it, but you better be reading The Rotten Heart of Europe because it's all in there. And go follow it through. Bernard Connolly was dead right on target. Just follow it through. You cannot get away from it.
Is it safe to say you think that Europe is still the biggest problem globally that could sink the entire global economy?
And becoming bigger because as the euro strengthens to the yen, and the motor of Europe is Germany. As Japan's recovery takes place, it'll be at the expense of German exports and slowing of German economy.
Ira Harris, thank you for your insightful analysis into what's going on in the global markets. I agree with you. I don't think it's going to end pretty. Thanks for joining us on USAWatchdog.com.
You're welcome, Greg. My pleasure.